Welcome to The Explainer. So we've all seen those terrifying headlines when the market suddenly takes a nosedive, right? The widespread panic, the red arrows pointing straight down on the trading floor, the breathless news reports. But what is actually happening beneath all that chaos? Today, we're going to unpack the history of modern financial meltdowns to see exactly how they shape our world. We're not just throwing numbers at you. We're diving into the real stories, the catastrophic mistakes, and the wild recoveries that followed. Let's get right into it. But before we can even try to predict the future, we really have to ask ourselves, what triggers a global economic collapse in the first place? Because honestly, here is a hard truth. History shows us again and again that absolutely no economy is immune. And yeah, the world looks totally different today than it did 100 years ago. But human psychology, greed, panic, those remain incredibly consistent. So to figure out what might bring the markets to their knees tomorrow, we have to look at what brought them down in the past. We are going to time travel across a century of financial history. First, we'll look at the anatomy of a market crash. Then we'll hit 1929 and the Great Depression, the 1973 oil crisis, the 2008 global financial crisis, the 2020 COVID-19 crash, and finally, what it all means for the next inevitable collapse.
All right, part one, the anatomy of a market crash.
To demystify all this chaos, we first need to understand the underlying framework that connects literally all of them. Every crisis follows the strict four-part cycle. First, you have step one, the spark. That's the specific event, the bubbling pressure that finally bursts. Then, step two, what happened? This is the immediate chain reaction and the sheer panic that follows. Step three is the impact, how the collapse bleeds out of Wall Street and totally damages the real world. And finally, step four, the resolution. These are the massive, often unprecedented actions taken by governments to stop the bleeding. Keep this exact framework in your head because you're going to see it repeat over and over again.
Which brings us to part two, 1929 and the Great Depression.
So let's go back to the fateful morning of October 29th, 1929, Black Tuesday. The air on Wall Street was just thick with tension, and men in crisp suits stood there in sheer disbelief, watching stock prices absolutely plummet. Fortunes vanished in hours. The whole thing was a fragile house of cards built on roaring 20s optimism and crazy easy bank credit. For years, ordinary people poured everything they had into the market, thinking stocks could only go up. Meanwhile, banks were recklessly lending money to investors who frankly had zero means to repay it. So when that bubble popped, panic-stricken citizens rushed to pull their money out of the banks only to find empty vaults and locked doors.
The impact here was visceral, and it was global. U.S. unemployment skyrocketed to a staggering 25%. Just pause and think about that. 1 in 4 people completely out of work. Breadlines stretched for blocks. Out in rural America, farmers were facing ruthless foreclosures right alongside the environmental disaster of the Dust Bowl. And the pain wasn't just in the U.S. either. As nations desperately raised tariffs to protect their own economies, global trade practically ground to a dead halt.
As for the resolution, well, President Franklin D. Roosevelt introduced his famous New Deal programs, which created a much-needed lifeline and social safety net for millions. But if we're being historically accurate, economic stability wasn't ultimately fully restored until the massive industrial push during World War II. It was that rapid global mobilization that finally ended the Depression.
Moving on to part three, 1973, the oil crisis.
Fast forward to October 1973. Now, the spark this time wasn't a stock bubble, it was a silent weapon unleashed by OPEC during the Yom Kippur War. They imposed an oil embargo on countries supporting Israel, and suddenly, the world's most powerful economies were just gasping for fuel. Oil prices didn't just rise, they literally quadrupled overnight. We're talking a massive jump from around $3 a barrel to nearly $12. This turned a routine trip to the gas station into a desperate hours-long battle. There were massive lines snaking around blocks, and some stations just completely ran dry. This intense energy spike crippled businesses and unleashed a terrifying new reality that left economists totally scrambling. It triggered something called stagflation. This is a rare, absolutely devastating, and toxic mix of stagnant economic growth, high unemployment, and runaway inflation. The cost of everything skyrocketed. Jobs vanished, but prices just kept going up. It totally broke the traditional rules of economics at the time. The aftermath of this shifted the entire global power dynamic squarely toward oil exporting nations. They became economic kingmakers overnight.
It was a massive wake-up call that forced Western countries to fundamentally rethink their energy strategies. Suddenly, there was a huge focus on fuel efficiency, building up strategic oil reserves, and heavily investing in alternative energy sources so they'd never be caught off guard like that again. Okay, Part 4, 2008, the global financial crisis. Most of us remember this one. The spark here was a massive collapse of the U.S. subprime housing market, fueled purely by greed and really poor oversight. Let's break down exactly how Wall Street manufactured this mess. Banks were issuing super risky subprime loans to practically anyone. Then, they bundled these high-risk mortgages into incredibly complex financial products, like mortgage-backed securities and CDOs. The crazy part? Credit agencies rated these toxic bundles as totally safe. But of course, housing prices peaked, buyers defaulted en masse, and giant Wall Street firms like Lehman Brothers completely failed, which essentially froze global credit overnight. The impact was devastating. Trillions of dollars in wealth just disappeared. Stock markets crashed, and millions of ordinary people lost their homes and their jobs. The government realized they were staring into the abyss, so they desperately rolled out the massive $700 billion TARP bailout to prevent total economic destruction. They literally had to inject massive capital just to unfreeze the system. To finally resolve it, central banks around the world slashed interest rates to zero and flooded the economy with stimulus money. Lawmakers also passed much tighter rules, like the Dodd-Frank Act, to rein in Wall Street. But honestly, the lingering damage exposed a deep systemic fragility in our financial systems that a lot of people have not forgotten.
Part 5, 2020 and the COVID-19 crash.
So at the start of 2020, markets were absolutely soaring. But then came the spark: global lockdowns and economic halts triggered by the rapid, unseen spread of COVID-19. Panic spread like wildfire. In March 2020, fear of a total global recession caused the Dow Jones to suffer its worst single-day drops in history. We're talking Black Monday and Black Thursday. And to make matters worse, this was compounded by an intense oil price war between Saudi Arabia and Russia. But then, fueled by tech stocks and rapid government stimulus, the market rebounded incredibly fast, ending the shortest bear market in history by August 2020.
But if you look closely, an incredible disconnect emerged here. While tech giants like Zoom and Amazon helped Wall Street bounce back at record speed, real people on Main Street were suffering long-term economic devastation. Small businesses were shuttered and massive amounts of jobs were lost. It laid bare this brutal reality. The stock market was celebrating while everyday people were just trying to survive. The resolution for this crisis was a harsh reminder of just how crucial massive government intervention can be when facing unpredictable chaos. The U.S. Federal Reserve slashed interest rates to zero again, and Congress passed the historic $2.2 trillion CARES Act to prop up the economy. Policymakers basically had to put a giant multi-trillion-dollar floor underneath the collapsing global economy.
Which brings us to Part 6, the next inevitable collapse.
Now, this is the most important part of this entire explainer, what you should actually take away from all this history. We've seen the 1929 stock bubble, the 73 oil embargo, the 2008 subprime greed, and the 2020 pandemic freeze. The crucial point here, while the exact sparks always change, the underlying anatomy of panic and fragility remains identical. No economy is immune to collapse. Crashes happen fast, but recoveries for everyday folks are painfully slow. That disconnect between Wall Street and Main Street definitely persists. And perhaps the scariest part, historical lessons are almost always forgotten as soon as greed creeps back in. History shows us without a doubt that this cycle will repeat, which leaves us with one final, incredibly urgent question. What will trigger the next collapse? And more importantly, are you prepared for it? Understanding these patterns is your absolute best defense against the unpredictable. Thanks for joining me on this deep dive. Stay curious, stay prepared, and I'll catch you in the next explainer.